Welcome everyone to the Daniel Krug and Associates halftime market report for July 22nd, 2021. My name is Rocky Isman. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel M. Krug, CEO and Senior Wealth Manager, will be joining me in today's presentation. Just a reminder, this presentation is for informational and illustrative purposes only. Today's agenda, we're looking at about a 45-minute. Today, we're going to be kind of going over the market review, where we're at year-to-date, mid-year, then looking kind of where we think we are going the second half of the year into next year. We're going to talk a little bit about positioning the portfolios based off of what we see coming.
Well, good morning, everyone. It's good to be here again.
Good to see you guys.
Or if we could see you guys, right?
We know many are on, so that's good. Hey, mid-year.
Yeah.
We got to talk kind of. Can you believe it's already July?
Yeah, half the year's gone.
I know it's gone by fast, especially coming out of last year, which kind of seemed to be a very slow, uncertain year.
Yeah.
Into a very fast-paced kind of growing economy. A lot of things going on. We want to talk about that. So.
Yeah, there's a lot. We're gonna kind of hit things pretty fast here. Keep in mind that you've got the ability to watch this again on YouTube. So you'll be sent a link probably on Monday to let you know that the replay is available for you, and you can watch as many times as you want. Tell your friends too. We would like to see as many people really get the information that we're presenting for you, our clients, and for anyone else who finds it really interesting and valuable to them. So tell your friends, and let's go ahead and get started. Let's look at the market review. Now, you can't talk about the market without really talking about the vaccinations that are going on, the economy's opening back up because of it. And this slide here really shows you a map of the earth. And the way you can kind of look at this map is you've got the green areas are the areas that are more vaccinated. And then the red areas are the areas that are fewer vaccinations. And you can see that the US and really Europe and parts of South America are really doing very well at getting the vaccination rate above 50%. But then you've got other areas, really your emerging markets, Asia, Africa, that are having a harder time getting the distribution. What we're seeing is with our economy, with Europe's economy, and certainly even with parts of South America and China are actually doing a very good job. And you're also seeing these economies open back up a lot faster as well. That being said, knowing that the economies are opening up, let's see how things are working relative to the markets. You know, as the economy recovers and we get through this pandemic, what we're seeing is a dichotomy in returns a bit. You can see that the US market is really doing quite well, bouncing back from last year. And most of you have seen your investment reports. Last year ended up being actually a very good year, and is being followed by a second good year. Matter of fact, the US equities have marked 34 record highs already in the first half of 2021. It's really moving forward. You can also see good movement in international equities and emerging markets. And you're seeing up on this chart, the second quarter and year to date. So the second quarter has been pretty darn good. Now, when you look at the year to date numbers, though, you do see where there is an imbalance. Equities are moving forward, but you're seeing that bonds are actually lagging. And, you know, it shouldn't be a surprise to any of our clients. We've talked about this for quite some time. that bonds are in a secular bear market. So the returns on bonds are not going to be anything near like they were in the, let's say the 2000s and before that as well. Being a secular bear markets will have many bears and many bulls in it. And the second quarter would be considered a bull for the bonds. But you can see as a whole for the year, it's lagging behind. The second quarter has not been enough to make up the difference in the losses from the first quarter. So we'll keep an eye on that, but it is an important fact that we need to be looking at when it comes to investing. More conservative investors are going to be hurt, and they're not going to get the returns that they were, maybe had in the previous decade. And we have to start looking at alternatives and more equities to get those returns the way clients need them. This chart, it's kind of a busy chart, but really the only thing I want you to focus on here this chart's all about news. So you look at it, the blue is the economic news, the gold is market news, and the silver is headline news. And all we're trying to illustrate here is from April to today, effectively, you've got a pretty volatile market. And you can see that news is driving a lot of this. What we want you to bring away from the table on this is that the market is going to be a little bit volatile over the next 6 months, possibly going all the way into next year. But as you can see, from April to June, July, the market still is rising. So we're seeing some good things coming down the road, but expect volatility. That kind of brings us to, all the trillions of dollars that have been pumped into the global economy due to the reliefs, the pandemic relief that has been going on for the last year and a half. And this chart really illustrates the 3 recessions. You got 2008, which was the financial crisis. You got 2011 to 17, the quantitative easing, and now you got the pandemic. What this chart shows you is the percent of growth of the GDP relative to the dollars that have just been flooding in from the governments. In 2008, it represented 8% of the GDP. 2011 to 17, it was 15%. And as you can see, from 20 to 21, it is a whopping 21% of the GDP. So one of the things that we're seeing out there and is actually helping to drive this market is the stimulus packages that are going through. The reality is that stimulus package has not stopped. Matter of fact, I read an article today that from my representative that they are giving grants out from the stimulus packages for people who are behind on mortgages, behind on rent, behind on automobile payments. The stimulus is going to continue on for quite some time, and it's going to help boost the economy moving forward. When you think about the economy and then you think about interest rates relative to that, again, there's a lot of talk about interest rates, inflation, all this coming down the road here. We're not seeing it long term, and the Fed is not either. So the Fed is really willing to let interest rates go up a little bit right now because of 2 reasons. Number one, we're coming off of last year where interest rates were actually very low. This is just helping balance out that average 2% target that they're trying to accomplish overall. The second reason is that inflation isn't across the board. There are targeted areas that are certainly a bit out of control. If you're buying a used car, you would know that because the used car market is up about 30% over last year. The wages are spiking right now. Housing, as far as building, getting labor for people who work in restaurants, those are areas that are getting hit hard. Anything that has to do with travel is inflated right now. However, when you look at the durable goods, that's not really spiking much right now. Matter of fact, that's rather normal at this point. So like the stock market, there is kind of a K-type inflation thing going on right now, where certain areas are spiking up, other areas are staying quite normal at this stage. So we're not worried about inflation at this point, and again, nor is the Fed. Now, let's take a look at the municipal market right now, because there's an interesting thing going on right there compared to treasuries. The treasuries are actually in a negative position right now as of 6/30. So this is a year-to-date and 12-month return situation here. 12 months is the blue bars and year-to-date is the black bars. If you go all the way over to the right, you can see where the returns are when it comes to the municipals. It's in high yield municipals right now. And we're getting a pretty good return right there. And you might find that it's in many of the blended portfolios to help boost the returns. Now, the other thing you got to keep in mind with municipals when it comes to high yield, anytime you're dealing with high yield, you're talking about more volatility. So you got to be able to take the extra risk if you're going to go into the high yield markets there. Let's talk about investment grade bonds. Again, going back to the fact that we're in a secular bear market, we are not anticipating that the bonds are going to do very well over, man, it could be 10 years before we see any kind of decent returns out of bonds. This graph really shows the US against Europe, and then the current US 10-year inflation expectations, which is really a little over 2%. Overall, going forward, we believe they're still going to be targeting that 2% mark. But if you're a traditional balanced portfolio person, it's a little bit more difficult to get those returns because the corporate bond yields are just not paying out what they used to. You know, US is certainly better than Europe, but still not where people have been accustomed to prior to 2012, 2013, when they pretty much called that secular bear market for bonds. Rock, kind of handed over to you on that, but yep. What do you think about what's going on with the inflation, treasuries? What's your take on it?
Yeah, we're going to go into that a little bit, but
so he's prepared. He's prepared.
We're going to talk about the markets moving forward, what we see over the next 6 to 12 months.
Okay.
So, but I think we've had an interesting ride the first 6 months of this year.
Yeah.
Equities have done well.
Yeah.
You know, and what do we need to have good equity returns? We have to have expansion in the economy. We have to have growth in revenues and profits. And let's talk a little bit about where we think things are going to be going.
All right, let's go ahead and do that.
So, mid-year, looking forward, there's 2 or 3 points I want to make about what we see coming up over the next 6, 12 months. The first major things that are taking place is the government has got involved with a couple of infrastructure packages. This is the first, the $579 billion that's already been approved by Congress and in place. And what I want to do is kind of show you the breakdown of where the spending is targeted to go, and then how they're going to generate the revenues, because the reason this passed with bipartisan support is because it comes with no new taxes. So when you look at this package, we're talking roads, bridges, waterways, and major projects getting the lion's share of the funding. Public transportation, water, which has been a big issue in Michigan, the power grid, you can see towards the bottom, and then a bunch of other miscellaneous projects. But that's what makes up basically where the spending is going to take place, starting here in the second half of the year going into next year.
Funny, Rock, I think back about where this bill was in the infancy stage, where it was what, $1.7 trillion is where they started at. Yep. And there was plenty of pork in that bill initially. So it is good to see that they've reined back a lot, because we can't spend forever, can we?
No, but in talking about the spending side of it, you can see the revenue where they're saying the revenues are going to come from. So there's actually been a less use of the budgeted COVID relief package that started last year with all the stimulus and everything. So there's a lot of money that they're going to transfer over to infrastructure. I don't know if you've heard, but they're hiring more IRS agents that are supposed to be reviewing tax returns that are on that above $400,000 income level.
Awesome.
And so they believe that they can get 100 billion just in tax enforcement, selling off government assets. And also just the fact that they believe the economy is going to grow. That's what the macroeconomic impact is. Just through natural growth, we're going to have an increase of taxes coming in, not new taxes, just current taxes, but more earnings and more profits generating more taxes. So tax revenues. And then they got a big chunk still, 225 billion, that they've got to go back to the budget and reapportion from existing budgeted items. So there's still work to be done on this, but that's how this part got approved.
Well, I find it interesting when you talk about the sale of the Spectrum and storage oil reserves. Remember back a year and a half ago when Trump bought all that oil really cheap?
Yep.
You know, it's good to see that the government is actually buying low and now selling high.
Yep.
Isn't that a great concept?
Now, this is the bill that is actually in Congress being debated right now. Biden came back and said, I want to add an additional 1.5 to 2 trillion package. And this package, though, has to be supported through tax increases. Okay, so that's why this one's a little harder to get through. But basically, we're saying that, you know, this also, if this goes through, this can help prolong the expansion of the economy. And what this chart is basically showing is in what years we would see the majority of that spending come into play and expand the economy. And year one is actually 2022. Year two is 2023, and so on. So actually the most spending is going to happen in future years, which is why I believe the stock market is staying high and looking at opportunities to still grow, because there's a lot of infrastructure spending being worked on in Congress that are going to create jobs, going to create growth, profits and revenues for corporations moving forward.
Now, I keep up with a lot of the bills that are going on out there right now. My question is, because I have not read through this one yet, which I will, but what the heck is human infrastructure?
It's more relating to jobs, job creation, things like that. The other was roads, blah, blah, blah.
Yeah.
This is more in training people to do the jobs of today. Stuff like that. So we'll see how this all plays out. Let's look a little bit at what we see coming in manufacturing and housing. Now, the chart on the left represents the manufacturing index and how you can see this steep growth that has taken place since March of last year in manufacturing. The dotted blue line represents where we were pre-COVID. And as you can see, manufacturing is way above the trend line that we were ongoing before COVID hit. So the recovery in manufacturing has been phenomenal and it's staying above average. However, there are disruptions in the supply chain, and that is bringing some of this downturn that you see going on here in June. Everybody, I believe, has heard about the computer chip shortage and how their cars can't get the computer chips. Well, it's not only in cars, it's also in things like even your washing machine today has computer chips. So it's affecting a lot of areas of manufacturing. On the right side, you see what's going on with housing. And I think people that are tracking and looking to buy a home or wanted to buy a second home saw just prices shoot through the roof over the last 12 months. And that's what you see on the right side here is the housing, existing and new home sales. If you look at the dotted blue line, which represents where we were pre-COVID, we're staying way above that pattern of growth in home sales. Again, why is it turned down? It's basically because there's not enough supply.
Yeah,
There's not enough new homes and existing homes for sale for the number of people that want to buy them. So it's brought it down. But from a historic perspective, we are still very bullish on manufacturing and housing moving forward. People are talking about inflation. There is definitely inflation going on, as you can see on the left side of this chart. This consumer price index, seasonally adjusted year over year change, averages about 2%. If you go back and look at the blue line here, you can see what's going on. Then where the dip took place when COVID hit, we basically shut the economy down. So you couldn't spend, you couldn't buy, prices didn't go anywhere. And since then, you can see how strong the inflation, bringing the economy back up and into running again, how it's increased. And we're at about a 5.4% inflation rate in June compared to June of last year. But that's a little deceiving in the fact that June of last year, the economy was still shut down.
right.
So this is expected. And where's most of that inflation coming from? Well, look at the right side. When we look at the different components of the consumer price index, housing, transportation, food and beverage, medical, and so on, you can see that 5.4%, or that black line, most sectors are actually under it. Most sectors are actually in line with a 2 to 3% growth rate. It's basically transportation, which is your gas prices, your car sales, your travel, your hotels and airlines. Those, because they were completely shut down and the economy is opening up, you're seeing a huge growth, 21% inflation rate inside the transportation sector.
Wow.
But we believe that will moderate and bring everything back in line down to that 2 to 3%. It's just going to take another 6 to 9 months probably to work that through.
Well, then you can kind of see why the Fed's not really in a hurry to put the brakes on that.
Right. They believe this is just, temporary. Another factor we look at for growth moving forward is what's going on with households. And these two charts represent, the left side is household net worth. And what's really amazing is the fact that coming out of COVID, which is the black line, how much household net worth has grown over the last 6 to 8 months. It's at about a 20% increase year over year. And if you look at the dotted blue line, that represents an average of the last 5 recessions, how household net worth grew. So you can see this has been a much stronger recovery for the consumer because their net worth, which did go down, has grown back strong and is at an all-time high. And that also relates to the chart on the right, which talks about household debt, the household debt service ratio. And this line represents basically how much the ability of people to take on debt based off of their disposable income. And we want this line to go down because that means that there's more disposable income out there for people to use to spend and keep the economy going. So we're actually at a very, very low, all-time low since the 80s, as far as debt to disposable income on household. So this picture to me says there's a lot of ability for the consumer to get out and spend. Now, we talked about some of these individual economic indicators. Let's look at the big picture. And what this is representing, this is actually going back to January, saying where were we with the 25 economic indicators at the beginning of the year. And if the indicator is green, that means it's in a positive trend. If it's yellow, that means it's neutral. It's not neither moving forward or backwards, it's kind of staying neutral. And red means it is negative. It's a bad or negative trend. And the only thing that was negative back in January was the political environment coming out of the election and the geopolitical risk issues around the world, Russia, China, things like that. When we look at this picture though, look at how many are yellow. It's kind of a neutral. It's not necessarily looking positive or negative for the next 6 to 9 months. Let's forward now to what the picture looks like in July. And what you can see is there's a lot more green, no red, and less yellow. So I'm gonna flip back and forth and talk about specific things.
Hey, Rocky, that kind of looks like my yard.
In yard.
The grass is green, but there are a couple yellow spots for the big dogs.
So that's not too bad. You don't have any red spots.
No red spots.
Looking back at January, look at the top line, the yield curve and disposable personal income were kind of yellow. We weren't sure which way this was going. Look at today. The picture looks much better. Second line, labor market was yellow. Today, that's improved. Third line, business outlook and international economic outlook were kind of neutral. And the political environment was red. Improvements there. And the bottom line here with the credit availability, energy costs, and equity market valuations and geopolitical risk. Again, we've seen improvements in every one of those indicators. So I think that the message is the next 6 to 9 months, what the leading economic indicators are telling us is that the economy is on the right track to expand. Another thing we like to look at is gross domestic product. What's the overall picture and what do we think the overall growth is going to look like for the United States moving forward? As you can see in the middle of this page, Q2 through June, the growth rate range is going to be somewhere between 8 and 10%. That's 4 times the average growth rates. So in 2021, we're projecting to end up somewhere between 5.5% and 7% growth in gross domestic product, which is expansion of the economy. Very robust, very bullish.
That's rather up from I think the last 2 meetings we had, webinars, because I think it was
4.5 to 6.
Yeah.
So they bumped it up a
increased.
little bit. And I think that's because the economies actually did open in
Yeah.
a lot of states. And for 2022, we're kind of forecasting still being very, very strong, somewhere between 2.5 and 4.5%. When you look at the bottom of this, and I want to focus on corporate profit growth, this year we're estimating corporate profit growth for the S&P to be somewhere between 27 and 33%. Huge. And why we're seeing the growth in your portfolios this year.
Yeah.
Next year, it's going to come down. It's going to slow down, but still 10 to 20%, somewhere in that range is very, very strong corporate profit growth projected for next year. And how does that play into where should be invested in stocks or in bonds? What this chart basically talks about is the equity risk premium. So what is equity risk premium? It is how much more an investor should expect to get a return against a fixed income asset, a bond, money market, CDs, things like that. So if your zero line represents that there's no benefit to being in stocks and anything above that is a benefit, you can see where it's actually tracking. The risk premium has been running between 3 to 5.5, 6%. And we see that moving forward. Again, one of the reasons, as Dan talked about, the bond markets, the interest rates are low and they're not returning the yield. So if there's not a return there, that makes stocks relatively cheap compared to bonds from an investment standpoint or a risk premium standpoint. So we are still very bullish on stocks moving forward.
Well, I think it's rather interesting. Again, we could stop the year right now and say from a market standpoint and investment standpoint that, hey, we won, right? I mean, all the accounts are just booming right now. But we've got another 6 months to go, 5.5 months to go.
Yep.
So there's still a lot that's coming down the pike here. Albeit it will be volatile as more and more news comes out, especially the news on taxes. So let's kind of go into that. Take over here relative to the portfolio positioning for the future, and let's see what we have. We're going to talk about a little bit about global earnings, U.S. developed markets. Where do we want to invest? Where do we see that there is going to be improvement in the market? Because again, with the way we manage the portfolios, we manage the overall portfolios, and the fact that we just got stellar institutional money managers, we want to be able to pick the areas that are going to have most growth. So let's take a look at this graph. The graph really shows the S&P 500, which is in black, the 400 in dark blue, the EFA, which is in the light blue, and then the lightest blue is EM, emerging markets Asia, and then the red emerging markets. When you look at this chart from 2021 moving to 2022, you can see the areas that are going to have the most growth really are still US mid-cap. We're going to see it in developed international and a bit in the US large caps. That's still the area to be focused on relative to getting the returns in the market. The earnings per share is going to be there. That's where the growth is going to be. That's one of the things that we're looking at right now, not sitting in the emerging markets or emerging markets Asia at this point, although that will be coming down the road. When you look again at investing and you look at it more from a tactical standpoint, this chart shows your year-to-date, 1 year and 5 year returns through June 2021. And what you're seeing here is the US large caps year-to-date are really doing the best, but developed international is not doing too bad either. And for a year-to-date standpoint, now we're always looking at this comparatively to the different sectors out there, but emerging markets have come in at about 7%. You look at 1 year back, and you can see almost all 4 of those areas were hitting, all 8 cylinders. The only thing that was a little bit lower was the developed international. Now, you go back 5 years, and again, the US large caps is where the increase is in the markets, as well as emerging markets Asia. So these are the areas that we're looking at when we're trying to determine what is the best place to invest and where do we want to be weighted within each one of these portfolios. Rocky talked about the markets as a whole, overweight, underweight. We're going to look also at this chart here. What you're seeing is in the black is a 20 years return. And then the blue is the near-term forecast. And then ultimately, the yellow dotted line is the expected inflation. When we're looking at this, we want to determine, where's the growth going to be relative to what we've been used to. And one of the things you can see in this is that most areas are not projected to perform as well as they have in the past. Now, there is a bit of a spread because you can't predict exactly where things are going to be going. So when we're looking at this, the 2 areas that tend to be underweight, developed international stocks and investment grade bonds. Just because investment grade bonds are underweight doesn't mean that's necessarily where you want to invest. Again, we are in a secular bear market. There may be times where we want to move into it, but then back out, but that's more of a tactical decision. But overall, even if you look at the large caps, a 6 to 10% rate of return, moving forward is not a bad thing. Same thing with small caps, 6 to 12, and emerging markets, 7 to 12. So we're looking at these, and we're really seeing some good things moving forward. Certainly over the next year and a half, we are risk on with the portfolio. Let's take a look at some tailwind as to what's going to help push us forward. Well, we've got high levels of confidence. I mean, the outlook is just really kind of off the charts. And if you think about it, it well should be, because we haven't even completely opened up yet. You've got a lot of states that have opened their economy up 100%. You've got others that are kind of lagging behind. But as all of them open up, you're going to see higher levels of confidence, and the market's kind of showing it out. There is an upward earnings trajectory. It's continuing. It's moving forward. That's a good thing. There's more fiscal stimulus coming. To be argued whether that's good or bad. Short term, it's good. Long term, maybe not so much. and there is a supportive monetary policy. Now, let's look at the headwinds. What could actually slow things down? High valuations. If they get too far out of control, you're going to see people step away from the stocks that have high valuations, but that doesn't mean you don't have other opportunities in the stock market where there are underweighted valuations that you could actually move into. And again, our money managers are great at looking at those opportunities and executing. If we get into a rising interest rate environment, that could slow things down because that really affects borrowing and growth. Potential taxes, it says potential, but I think we all know it's inevitable. We just don't know exactly how it's going to play out. With all the debt that we have, there's no way taxes cannot go up. Could be a combination of growing the economy, probably should be a combination of growing the economy and taxes. But we'll be watching to see how that really affects things. And you really should expect that as they start talking about different taxes, that you will see some movement in the market, plus or minus, because of what they're saying. And then there are pockets of speculation. And what we're talking about here really are things like Bitcoin and the cryptocurrency and how that's going to affect things. So there is a lot of speculation in that area there. There will be some regulation that comes in with it. You've got other aspects.
Yeah, you got things like international issues, going on with Russia and China and speculating how that's going to play out and impact, global economies and things like that. Taiwan, all that stuff. So there's a lot of speculative things going on that we have to keep our eye on. And people are speculating even over what the tax impacts are going to be and making judgments without having all the facts yet. So that all creates volatility in the market in the short term. But we just want you to know we're aware of these different speculative things that are going on, and the money managers make adjustments.
Yes, they do. Yes, they do. Most of our clients, short of clients that maybe came on in the last 6 months, have gone through downturns with us, and they understand that, what they were used to prior to coming to our firm is their accounts going down and not coming back very fast. But since being with our firm, almost everybody has gone through multiple downturns and have seen how fast the accounts come back. And that's really the tactical effort of our institutional money managers that are allowing that to happen. Wrapping up here and where we are going in the future here. I believe most everybody has received an invitation to our grand reopening. So that's on August 20th, and it's going to run from 11 o'clock to 3 o'clock. It's located here, as you would probably expect, at the office. We would like you, as much as you can, give us an RSVP. That way we can give you instructions on parking. We can better estimate the food and the beverages for our clients. There will be appetizers and desserts served throughout the whole time. We will have entertainment. We've got a great singer that's going to be here to kind of entertain us at the same time. We'll have a big tent. Also, we're going to have Ollie the trolley back here, and the trolley will be able to take you to downtown Clarkston back. And it'll be a fun time. Call up, give us the RSVP for you. We'd love to see you. We'll give you a tour of the new office. It's really turned out phenomenally. The designer and the builders just did a great job. We're hoping to see you here on August 20th.
Yeah, I'd just like to add that it's primarily an outdoor event. I mean, we're doing this outside in a tent. It's kind of our first live event, trying to get back. We used to have a lot of meetings with clients and events here at the office. So you'll kind of see how we prepare to do that in the future. But again, for those that are concerned, it's primarily outdoor, under a tent, food, stuff like that, similar to what we did at the Dream Cruise.
Well,
looking forward to it.
You can't talk about investing without talking about advanced planning, because that, again, is where the extra added benefit really comes in. And a well thought out, well executed advanced planning strategy is going to net a client an additional 1% minimum. We really believe in the advanced planning of our clients' portfolios and overall estate. And we will continue on with that. We're always tactical in everything we do. You can see on this list all the different things that we take care of for our clients. We love doing this. The advanced planning is, for us older folks, it's the bee's knees. Works out really well for our clients. Now, let's talk about actions you can take. Well, first thing is you want to keep us in the loop when it comes to any kind of important events in your life so we can help mitigate any kind of gaps or issues that come up. You also want to share any concerns you have about your investments. And, talk it out. If you're concerned about the market, we're here to help coach you through that process. And then update your important legal and financial documents. We always want to keep those up to date. So if anything does happen, what you expected your legal documents to do will actually transpire the way you wanted them to. So we got to keep those up to date. You want to maintain or implement, if you have not done so already, your tax mitigation strategies. It really is going to be the hedge against rising taxes in this environment that we're in right now. So if you haven't started it, I would strongly recommend you get moving on it. If you are in it, most of our clients are actually doubling down this year to make sure that they are set going into next year, when we do believe the taxes will start going up based on the proposals that are out there. And then know your gaps. And really, we want to be able to devise a plan to fill those gaps. The more we understand what's going on in your life, the better we can serve you. And then there's no time like now. When you're going into a rising tax environment, it's a good time to set up or roll out your charitable intent, because it could really allow you to either give more or save more in taxes. We're looking at those for all of our clients as well, based on your needs. What are the action plans for us? Well, we're going to keep you informed through these regular communications. We're going to manage the investments according to your personal risk strategy and your goals, right? It's not all about the target rate of return, although I believe we're doing pretty darn good in that area with the money managers, but it's about the strategy and the goals you have. And we want to make sure we stay on track for that. And then stay on top of the changes in the market, as well as the tax and legal environment. We're always looking at the new bills out there to kind of see which way the winds are going from a tax and legal standpoint, to make sure we're prepared to keep you prepared. Then we want to make prudent adjustments when necessary as they relate to your long-term goals. So again, the more we know about what's going on in your life, the better we can serve you. So that kind of takes us to, hey, back to the YouTube channel. So if you want more information, just click on to YouTube, go to Daniel Krug and Associates YouTube, and you can check out all the different videos. We've got videos on all the different, or many of the different strategies that we do. And you can kind of watch them at your leisure. It wouldn't hurt to subscribe, because then you'll see all the new videos that are going on there. Or you could go onto our website, which has that as well. So that kind of, I think, wraps it up, Rocky.
Yep.
So we're coming to the end. So there's no need to worry. You take care of your family, and
we will take care of you. We're ready for the future.
All right.
Thanks
Bye-bye.
for joining. Good seeing everybody. Have a great day.